Good morning. This is Anthony Parent, and we are on a very casual Friday. And yesterday there was the news that the Senate will pass tax reform on a simple majority vote. And so my feeling is now tax reform is going to happen. I think it is going to happen, and a lot of people are wondering what exactly it means. And I've been dealing with media requests about that. I have been part of the reform effort, especially on territorial tax jurisdiction and repealing FATCA, which is harming a lot of U.S. expats overseas. And some of what I'm doing there might be hurting my own interest, because we do have a lot of expat clients who run into issues with the IRS because of technical filings. And some people have criticized me for not looking at my own best interest by getting a change in the law that could reduce our hourly billings. I don't quite look at things that way. I believe that this tax reform package, the general themes of it, are very good, and there's a lot of benefit. And I think for those tax practitioners out there who are concerned that their business is going to be limited, I'm going to say you're probably looking at things a little incorrect, because we live in a dynamic world. Now, for those of you who aren't in the tax industry, let's go over some of the winners and losers of this tax proposal. Now, again, we don't know what the exact final plan is going to be, and with tax, you always can sneak something in there that is a surprise, because it's a little complicated, and oftentimes our representatives don't necessarily read what's in there. Sometimes we find sections of the code that are basically written by lobbyist groups, and one I can think of, an example I can think of is the 1986 reform package. That was the whole code section was put in about passive foreign investment companies, PFICs, and that was basically written by the Wall Street financial service lobby to punish owners of foreign mutual funds by creating an onerous reporting regime and a tax treatment that isn't as advantageous as domestic mutual funds. So with that, the general outline, as I look at it, there's no losers in this tax reform package, no U.S. losers. Okay, I'll explain that, why I'm saying U.S. losers. Looks like everybody's gonna win. Now, there's some people who might not see much change, and those people are your high-income wage earners. They're pretty much gonna be stuck with the same thing. Still a high marginal rate, could be 35%. Could stay the same at that 39.6%. I'm thinking it's going to be 35%, so a little bit lower, but it looks like some of their deductions are going to be taken away too. So I'd say a wash for them. They're not really looking at any big benefits. Now, pretty much everybody else is a big winner. And actually, those high-income earners who are paying the alternative minimum tax, they're actually going to be the winners, because the AMT, if your AMT tax is higher than your federal tax, you pay the AMT. So a lot of these people will see a benefit, because the AMT is going to get the heave-ho. And it's about time, I would say, on that. It creates a complicated parallel taxing system that you have to pay a tax firm like mine to prepare, even if you don't file it. So it's a complete waste of time for a lot of people. And it's sort of outdated, too, that it was written at a time when there were some loopholes that you could really exploit and take advantage of. And so Congress says, okay, let's not let this happen. We'll get an AMT to get them this way if we can't get them that way. Well, those loopholes don't really exist anymore, so AMT sort of lost its purpose. So it's about time that goes away. Now, some of the other winners, low-income earners. We represent everybody in the economic spectrum. Some of our clients are incredibly wealthy. Some of them are recovering. And it is, when I see our office is based in Connecticut, and when I see what a low-income earner is making, and yet they still have a tax bill, I'm looking, it's like they don't have enough money to live on as it is, and here's a tax bill. So there's going to be some changes for them coming, and what I'm hoping is the simplified reporting requirements For a lot of them, they might get an earned income credit, but in order to get that, you have to pay someone to get it. And so, this is really, one of the losers, I would say, are the firms like H&R Block that make a lot of their money by helping out low-income people file these complicated returns. If those go away, their business is really going to be upended, why this is maybe not the most likely thing. I would say low tax rates are likely. A less complicated tax system, not as likely, because the lobbyists don't really care. If the lobbyists for these tax firms don't really care if the tax rates go up or down too much. But what they don't want is simplified reporting on certain things. They really don't want postcard reporting, because what does anyone need them for? So they're, H&R Block is billions of dollars each year, right? They have a lot to lose. So you can expect some intense lobbying from them. But overall, low-income earners, and I guess that's how you define low income. And I would say I'll define it low income for Connecticut, which is low income in Connecticut is basically under $50,000. It's very hard to make it in Connecticut with that. People make under $50,000 are going to see some benefits. It's really sad when you see somebody who has a child and making $50,000, and they still have a tax bill of $2,000. You're thinking to yourself, that's just not enough. So they won't be paying anything. So some of the other winners. Let's go through some of the other winners. Middle class, right? The middle class is going to be winning big time. But first, I want to talk about families. Families are going to be looking at a tax credit, a double tax credit for children, and so another $1,000 for each kid a year. That's fantastic. And I think, if you don't have kids and your income's high, you might not think $1,000 is all the money in the world, but we certainly have clients where that makes a big impact on them. That could mean the difference between getting braces or not. Things can be really, really tight. So that's a huge benefit to families there. The middle class overall is going to see lower tax rates and higher deductions, so they'll be paying less too. And just fantastic, because I think the thing is that through the years, I haven't seen incomes rise. I really haven't. Yet I've seen the taxes kind of go up and the costs go up. So there's more of a squeeze. And especially, one of the biggest cost centers for middle-class families is the healthcare. It's just crazy at this point. And the healthcare is going up. Something's got to give, and lowering the taxes could help, and also maybe freeing up the markets, letting people decide where they actually can spend their money can help out tremendously too. That's a different topic. I'm not going to get into that. Other winners, big winners, small businesses. Oh boy, this is really, really interesting. I'm really excited about this. Small businesses and the self-employed. The first surprise they always get is that their first year in business, when they start to make money, the self-employment taxes. When you're employed by someone else, your employer is picking up half of your self-employment taxes. So you don't necessarily see that. You don't see the whole tax, but when you're self-employed, you're paying all of it. And that comes out to about 17%. 17% just to stick it into Social Security and Medicare. So talk about going down in an empty hole. And then on top of it, you have your federal income tax to pay. So it gets to be very difficult to have the extra money you need and manage your cash flow correctly. That's what small businesses really need. Well, here we're going to see, we see this proposal of a 20 or 25% tax rate for small businesses, which I believe would be the actual ending rate, not another tax rate, but just the final rate on the individual. So you're talking about the person who is going to go into business for themselves, could be making the same amount of money, high income, as someone who's a waged employee, but they're going to be paying less. So this is going to create an incentive for a lot of individuals who might be high wage earners now to say, I'm going to leave and start my own business because I could make less, but actually end up with a larger net because my taxes aren't so high. And what I'm thinking about specifically is doctors. Around here, Yale Hospital's buying up every practice, or the Hartford Hospital is buying up every practice. And it seems, as I talk to people around the country, same sort of thing. Doctors have been squeezed out from their own managing their own practice. They have to sell their practice to one of these large conglomerates, and now they're an employee of that conglomerate. Well, now they're, as that employee, their taxes aren't going to go up, but they're not going to get the benefit of being their own boss. So I think you'll see a lot of doctors who might actually not be all that happy being the employees. They lost their autonomy. They can't practice medicine the way they really want to because of their wonderful overlords. So I think you're going to see a lot of people, a lot of docs moving in. Even if they make less, they're fine because they get to work the way they want to and they'll pay less in taxes. And there's another benefit that's coming that's going to really help people like doctors in the tax reform. And this really has to do with capital investments. Now, if you're in business, you just know this because you've learned it the hard way probably. But if you're not in business, you might be surprised by something that you can have something that's a business expense. You say, oh, yes, you could write that off on your taxes. Well, not so quick there. For certain types of expenditures, you can't write it off on your taxes in the year you paid it. You actually have to pay that out, right, through something called depreciation. And it's a little bit nasty because you're paying for the thing at once, and sometimes you're financing it, you're paying for it at once, you're depleting your cash flow, but you're not getting the credit as you paid it. Now, you'll get it in future years, but the future years really aren't the concern right now. Plus, it's always worth more now than someday in the future. So the proposal is to say, look, pretty much anything that you're buying for your business, we're going to allow you to write it off immediately. So that's going to have a huge impact that basically any expense you could think of, you want to lower your tax bill this year to zero, just buy something. Buy some investment for your business, and it will probably be able to be written off and reduce your taxable income, growing for the future. And I mean, talk about giving people incentive to grow the economy. These two things right here, hand in hand, are absolutely fantastic. Now, my excitement gets even higher as I get to the next one, and that's the corporate tax rate, lowering that to 20%. I was hoping for 15. I think 15 would be so bold, it'd be so amazing. But a 20% corporate tax rate is fantastic. And let's just think about some things right now. And I'm trying to keep this as non-political as possible. I don't think it's quite possible with tax because it's inherently political, but let's just sort of try to keep this as friendly as we can. The U.S. currently has the highest corporate tax rates in the world, 35%, and that's actually not exactly true because there's instances where you could be charged a 38% tax rate. Yuck. And so what happens is you have your larger players, you have Google, Apple, stripping out their income in the U.S. and dumping it into some foreign jurisdiction where they have a tax deal. And so their income really isn't taxed in America all that well. It's taxed somewhere else at a lower rate. Well, and what's funny is that, the U.S. has the world's largest economy yet, the highest corporate rate. Yet despite all of this, I believe the total tax receipts from corporations is $200 billion out of the $3 trillion the government collects. So something's not working here. Something is not working at all. And the people who end up, the companies that end up paying the actual corporate tax rate are the companies that are large. They're sort of on their way up, but they're not to the top yet. They're at a disadvantage of getting to the top because they're every year they're handicapped by having to pay this 35%, whereas the large companies don't have to do that. So the large companies always have this advantage. Well, now this is going to level the playing field, and there's a ton of companies out there that the market they're $500 billion companies poised for something greater, but they haven't been able to get there. When you look at how many of those companies there are, it's staggering. And that if you just had all of these companies just merely double their revenues in 3 or 4 years, you're looking at a tax base that's incredibly larger. So that's where that's where I think this is just a great idea. Yes, the tax rate's going to be lower, but your tax base is massive. It's going to become massive. And now also, Google, Apple, all these other companies don't have the incentive to do all these hoops and hurdles to go offshore. Going offshore is not easy. It's expensive to do, and there's also opportunity costs related to it. It's just, where the companies balance the opportunity cost and the cost related to going offshore with what the 35% rate is. And in many situations, it's worth the hassle of going offshore. But at 20%, companies are just going to say, why bother? Now we'll just sort of leave it here and pay our 20%. And that's additionally, 20% is a lower tax rate, corporate tax rate, than the average. The average corporate tax rate is 22.5% worldwide. So now we're going to see a lot of companies, there's a lot of investment going on in Europe, a lot of companies saying, well, we should go to the U.S. too. So I think we're going to start seeing a bunch of influx of foreign capital into the U.S. will really be attracting a lot, and that's going to create a bunch of opportunities for people. The other thing too, we're going to see the repeal of the death tax. It's the supporters like to call it the estate tax. Detractors, we like to call it the death tax. As Senator Cruz mentioned the other night, it does kick in when you die, so it's fair to call it the death tax. The death tax, and this is what sort of bugs me about the death tax, is that it's something you could avoid with planning. If you have an estate tax due or something like that, you go to the tax attorney like us, and we can help you avoid it. Never pay it. So it's something that just a little bit of planning, a little bit of foresight, you should never have to pay or pay very, very little. But what happens is a lot of people don't realize that their stuff adds up to the estate tax. And so really all you're taxing isn't really an estate. You're taxing people who are naive, who didn't know to get a tax plan. And that just doesn't seem all that fair to me, even though, removing the death tax, I guess, harms my business in one sense, but I think it will pick up in a different sense that I'll get to later. Now the change that I've been working on the most is the change to territorial tax jurisdiction. So the big winners in this tax reform could really be the U.S. expats who have no income in the U.S. Their filing obligations are gone. For some of our clients, they file, we'll charge them thousands of dollars to prepare the returns, and because of the foreign tax credit for foreign income exclusion, they pay nothing to the U.S. But if they don't file, they're looking at tens of thousands of dollars of penalties that count towards a tax debt that if it isn't paid, the U.S. government can take away your passport, all for not even owing a tax. So it's a completely ridiculous system. So the switch to territorial taxation for individuals will remove a lot of those filings. Now, for some people overseas, they do get hit with double taxation because you could have, yes, you might be paying a foreign tax, but it's not the type of foreign tax that's allowed for the credit. So there's some really nasty situations where effective tax rates can get out of hand. And the point is that people, U.S. expats living overseas, none of them are really avoiding taxes. They're being taxed by somebody. I have a few clients in Dubai who don't have to pay an income tax, but for the large part, they're paying taxes somewhere, and they're paying a lot. And just throwing the U.S. tax compliance onto them is just adding, there's very little added benefit to the U.S. Treasury for a lot of headache, a lot of hassle. And then the other part of getting rid of that is essentially the Foreign Account Tax Compliance Act really loses a lot of its necessary, it just becomes a little obsolete. We really don't need it. The Foreign Account Tax Compliance Act was passed back in 2010, and this thing has been a disaster. Its proponents, the people who've supported it said it will help raise $1 billion in revenue, and I think that was over a 5 or 10 year period. But what it's cost globally for financial institutions on a yearly basis is in the billions. And these are costs that are passed on to everybody else. All for what? And it doesn't really help, anything. And it also creates a level of complexity that is above the ability of many IRS employees. Something that this is, when you get to foreign taxation, it is such a different animal, and it is so much more complicated than domestic taxation. It's true for tax professionals. Many tax professionals won't touch it. And those that's probably a good idea. If they're not comfortable, you shouldn't dabble in it. But the other thing too is there's a lot of IRS employees, auditors, who don't want to touch it either. I was talking to I won't give it away, but I was talking to a group manager from the IRS, and I was asking her how her international audits were going. She told me that her employees, about half of them, refused to do international audits, and I get it, because they're really complicated and time consuming for everybody, including the IRS. So removing this burden, and the IRS has half the auditors it used to. It can help the IRS move things along quicker. There's just certain people that aren't audited anymore. The audit rate for your plumber, 10 years ago, I'd say you might be audited if you do this, or it could raise red flags. Now, man, you got to do something crazy to get audited. You have to have someone complain about you or whistleblow on you to get an audit. The audit rate is down to 0.7%, where it used to be 2% or higher. I mean, and the field audit rate is just tiny. They just don't happen a lot. And so I think, people are figuring this out, that if you stop enforcing, people just don't take you seriously anymore. The IRS has to rule by intimidation and fear. And if you stop auditing people, you've lost your leverage on that. Now, let's talk about some of the losers here. Now, the thing that territorial tax will do is it will switch things around a little bit. For certain foreigners who invest in the U.S., their income's tax-free. They don't have to pay anything. So they get a lower tax rate than a U.S. citizen. I don't know if we like that so much. Well, territorial taxation will fix that. Now, the problem with that is a lot of investment houses don't want to be changed, because if it is, they're going to lose a lot of their foreign investors, and they're going to say, oh, the foreign investor is going to take off. Well, maybe not. I think it'll work out a little bit different. That you might lose some people, but they'll come back in a different way, or different people will come back. And plus, your tax rate that we're going to have on a lot of this is going to be 20%. So it's going to be a lower tax rate anyway. That it's going to be difficult to beat. And the U.S. is the world's largest economy, so the offer is still going to be pretty attractive to a lot of foreign investors. But then again, look at what's going to happen with the foreign, the corporate tax rate and non-U.S. money coming into the U.S. I think these investment houses are being, if that is your position, I think you're being a little short-sighted to say, okay, we're going to lose these individual investors, but look what you're going to get on the other end. A whole bunch more corporate money coming in. So what about the deficit here? Right, we have the U.S. budget deficit getting up there. It's up to $20 trillion. Well, yesterday it just seems it was $16 trillion. My, how has grown. So, as I've gone through, it's like, boy, everybody sort of here is winning. Okay, some high-income earners don't really get much, but everybody's paying less in taxes. So isn't this a bad thing? We're going to have a really hard time with our budget deficit. Well, I would say this. How did we get to the $20 trillion right now? You want to answer that? Through the current system. So it really seems to me that the current tax system is not working out all that well. If we honestly believe budget deficits are a problem, we should be demanding some sort of change. So I guess one of the changes we could do is, well, we can increase taxes. Well, I would say taxes have been increased. A lot of you might not know it, but there was the Obamacare tax increase, the net investment tax, and I added a 3.8% on a lot of passive income. And then you also saw rates go up from 15 to 20% plus the 3.8. So what used to be a 15% tax rate went up to 23.8% tax rate. And well, how did that help out the deficit? Oh, it went up to 20 trillion because before that the deficit was at 14 trillion. So it doesn't seem to be helping out at all. So we know raising taxes isn't going to help out the deficit. The status quo doesn't really seem to be changing. So we're left with one real option here, and that is to lower taxes and to make the tax code a little simpler. I think that's going to help out. Now there's some other, so what we look for, what I'm looking for my practice is that I think that for our clients, some of our clients we're not going to have anymore. They're going to be U.S. expats, and they're not going to need us anymore. Now, for some of our clients, we're going to have less work to do. But where I think we're going to be making up, and by a lot, is we're going to have a lot more clients. That we have, I know, my dad and I started in tax with just tax resolution, dealing with people who had tax bills they couldn't pay. And that was 12 years ago we were doing that. And that was a bulk of the work because people had these large incomes, something happened, they couldn't pay it. Well, our business has changed over the years because people stopped having those large incomes. So they didn't get into the tax problems that they normally would. And I've known these people, helped these people, and right now there are so many of them sitting on the sidelines. Maybe they're working a side job, but they're of the position, why should I risk everything? Why should I bust my stones? Why should I do all of this if I'm just going to end up giving so much of it to the U.S. government and leaving such a tiny margin of error for success? They have good ideas, they know how to run a business, and they're looking at it, and they're just simply saying it's not worth it. And so they're just sort of, waiting for something to change, or maybe they're just, doing something else. A lot of them might have a spouse that has a job that provides for the benefits, and they're just sort of doing something, working on some little project. There's a lot of people like that. You give them the incentive of a lower tax rate, so they're going to get right back into it. And they're really going to be, I think they're hungry to get back into it. And I think the president did say in one of the speeches, and I think he did say it pretty accurately, there's currently a lot of people on the sidelines. This is going to incentivize a lot of people to get off the sidelines. It incentivizes people who risk takers who want to make their business, and also helps out a lot of families. And I think those are two critical things if you want to see the country grow, right? If you don't have new people, country can't grow. And if you don't have new business, country can't grow. So those are the two main factors that I think this addresses. Now, as far as tax attorneys go, guys, I think this is a really good thing because think about it. The last time we had tax reform was 1986, and a lot of issues have been litigated. There's not too much more, there's not a lot of new products, new things to develop. A tax reform will give us a whole new blank, beautiful slate to find opportunities for our clients, won't it? And then also when we have, I'm thinking of the future, we're getting a lot of conservative judges appointed. Regardless of how you feel about them, one thing that I see that doesn't get to play is that a justice like Neil Gorsuch is not a fan of the Chevron standard that basically rubber stamps pretty much any regulation of the IRS. But if you actually had a regulation that wasn't automatically assumed to be legitimate by the courts, there's going to be a lot more opportunity for us to present an alternative side, and I think a lot of things to present an alternative side to help our clients. So I look at it as just a tremendous amount of opportunity. The other opportunity I see is a lot more business advice is going to be needed for clients. There's going to be a lot of new businesses. There's going to be mergers, acquisitions. There's going to be tons of that, a lot of activity. There's going to be a lot of foreigners who are going to need to create a U.S. entity and then bring that foreign investment and have that handled correctly. There's just going to be so much that I think we're going to also see less tax technical work, more business advisory work, even simple things such as accounting. One of the sad truths of where I do tacitly admit the IRS might have some sort of merit is where the IRS is a revenue officer gets assigned because a business isn't making payroll taxes. And the owner of the business sometimes is surprised to say, what? What do you mean? Of course I've been making my business payroll taxes. And then to find out that there has been embezzlement. And embezzlement can really only happen. You need two things. You need a lack of control, or that somebody has taken too much control, but you also need revenue, right? If you don't have the revenue, there's really nothing to embezzle. So where I think a lot of opportunity is going to be coming is as businesses start to grow and do a lot better, there's also going to be that opportunity for the person who is less than honest to embezzle from companies. And so that's really something that I am going to make a focus with my clients to say, let's make sure that we have our controls and that you don't have the one person depositing everything who's also the person who gets the notices from the IRS, right? So that is unfortunately a lot of times that is how employers find out that someone has been embezzling. The IRS lets them know to say, hey, you haven't paid something in a while, which surprises them. But there's also, and that's a terrible situation because you still the business has a tax bill to pay that we might not be able to negotiate. And it, causes a cash flow. To think you had money, to think the money that you thought was there wasn't there. That's pain for everybody. So that's really some things to think about, for tax attorneys, people worried about tax reform happening. Just to say it's a good thing. There's going to be a lot of changes. There's going to be a lot of opportunities. Yes, your clientele is likely going to change. It's going to switch a little bit. Its complexion is going to change a little bit. But their need for us is going to skyrocket, and that's really what I'm looking forward to. So I am a huge proponent of tax reform. I'm excited to see what happens, and I'm going to end this here. Just maybe advise you might want to subscribe to this as we go through and as we get closer and we see the actual bill that is presented. We'll be able to talk a little bit more about the specifics. This is Anthony Parent for Parent and Parent, IRS Medic. Thank you for joining me today.